NEOS offers some of the best monthly income ETFs on the market, which include a variety of funds with different asset classes, high dividend yields that are consistent and sustainable, and can help you build a solid, diversified income portfolio. And in this video, I'll be going through 7 of the best NEOS ETFs, along with a few important things to be aware of when investing in these funds. Quick reminder, this video is for educational purposes only. This is not financial advice, and I'm not a financial advisor. All investments carry risk, so always be sure to do your own research before making any investment decisions. Before we jump into the ETFs, there's 3 important details you must know when it comes to these NEOS ETFs. First is that NEOS ETFs focus on option-based income ETFs, and the funds on this list use cover call strategies to generate income. How this works is a cover call ETF holds a portfolio of stocks while selling call options on these same stocks in their portfolio. This strategy allows them to generate higher dividend payouts while still offering exposure to the underlying stocks or other assets. The second one is important when it comes to the taxes, which is that a majority of the income that's paid out from these ETFs is classified as return of capital. Return of capital is a return or payment received from an investment that's not considered a taxable event and is not taxed as income. These ROC distributions lower your cost basis, so essentially your income is tax deferred until you sell your shares or your cost basis reaches zero. If you look at the latest Section 19A for one of these funds, you can see how much the estimates for ROC are on the last payout, and the remaining is ordinary income. Just please be sure to keep in mind these are estimates and the final classification won't be known until official year-end data is provided. And the last and most important point is that all of these ETFs limit upside potential. This goes for all cover call ETFs. In exchange for the income from selling call options, you give up the gains above the option strike price. For this reason, these type of ETFs will underperform the underlying assets. For example, here's a chart comparing the S&P 500 to a S&P 500 buy-right index that replicates a hypothetical cover call strategy on the S&P 500. Over a long time period, you can see there's a pretty huge gap between the two in total returns. So these funds are going to be geared for those investors that are focused on income and not capital appreciation. And now that you're aware of some key details when it comes to these funds, let's get into the ETFs. First up is spyi, the NEOS S&P 500 High Income ETF. This fund aims to generate high monthly income and provide you with exposure to the S&P 500 index. So it uses a call option strategy that may include both sold and purchased S&P 500 index options. These S&P 500 index options come with tax benefits, and since index options are classified as Section 1256 contracts from the IRS, this allows them to receive 60% long-term and 40% short-term capital gains tax. And keep in mind, this is for the distributions that are not considered return of capital. When it comes to the fees, spyi has an expense ratio of 0.68%, costing you $68 for every $10,000 invested. And while this fee may seem a little bit high, keep in mind that it's an actively managed fund. For the portfolio, spyi currently has around 511 holdings. And the top holdings include companies like Nvidia, Apple, Microsoft, Amazon, and others. And the sectors it's mostly exposed to are technology, financials, communication, and consumer discretionary. So the stocks and sector exposure is very similar to what you'd find in a typical S&P 500 ETF like VU, SPY, and others. Now let's talk about the income, where spyi has a dividend yield of 11.6%, and the dividends are paid every single month. And if we check out the last 12 months of income payments, we can see that spyi has been pretty consistent with very small fluctuations. This of course is normal since it all depends on market volatility, which plays into the option premiums. This leads me to the performance, where in the last year, spyi has had total returns including dividends of 15%, and since it was created in August 2022, total returns of about 62%. So it's done well in these last few years. The best part of spyi is that it gives you diversification to the largest 500 companies in the US thanks to the S&P 500 index. This can be a core holding for an income portfolio since it'll have a variety of resilient companies. The S&P has been performing great, and it looks like it'll continue doing so in the near term, which is a nice plus for spyi. Now, the downside is that the top 10 holdings, like the Mag 7 names, make up a decent portion of the portfolio. So if something dramatic happens to these stocks, or the sentiment in tech and AI flip, that could hurt the fund some. but SPY is a solid income fund that gives you exposure to the S&P 500 while still managing to provide some consistent and stable income. So if you're looking for a high income fund that's diversified across a variety of large cap names and sectors, SPY could be the right ETF for you. Next up is qqqi, the NEOS Nasdaq 100 high income ETF. This fund seeks to generate high monthly income and provide exposure to the Nasdaq 100 index. And this index holds the largest 100 non-financial companies in the Nasdaq. And this fund uses a call option strategy that might include both sold and purchased Nasdaq 100 index options. And like SPY, qqqi gets those same tax benefits of 60% long-term and 40% short-term capital gains tax since it uses those index options. For the cost, qqqi has an expense ratio of 0.68%, costing you $68 for every $10,000 invested. Getting to the portfolio of qqqi, this fund has 106 holdings, and the top 10 holdings include NVIDIA, Microsoft, Google, Walmart, and more. And the sectors it's mostly exposed to are technology, which makes up over half, then communication and consumer discretionary. The holdings and sectors that make up qqqi are going to be very similar to a Nasdaq 100 fund, which has a heavy tilt towards the tech sector. qqqi comes with a very nice dividend yield of 13.8%, and it's paying out every single month. Looking at the last 12 months of payouts, qqqi has managed to also be very consistent, and thanks to the levels of volatility that the Nasdaq 100 has provided, qqqi has been able to provide a great yield. Now, qqqi has only been around since January 2024, and in these past 2 years, it's had total returns of nearly 44%, including dividends, which is great to see. The Nasdaq 100 gives you exposure to some of the top names in technology and innovation, which has allowed the index to have some amazing returns, which is a direct benefit for qqqi. The continued demand for AI and AI infrastructure are huge tailwinds, along with the strong earnings growth that these companies have been having. This doesn't make this fund perfect, since nearly half of the portfolio is the top 10 stocks which lean heavy into tech. This more concentrated exposure to technology adds risk, since it makes it much more vulnerable to any downside risk that the tech sector faces. But if you're looking for high income and you believe in the continued growth and dominance in tech through the Nasdaq 100, then this could be a fund to consider for your income portfolio. The next ETF we have is NIHI, the NEOS MSCI EAFE High Income ETF. This fund gives you exposure to the MSCI EAFE Investable Market Index, which invests in developed markets outside of North America. And it's going to have the tax benefits of 1256 contracts like the previous ETFs, since it uses index options. For the fees, NIHI has an expense ratio of 0.68%, costing you $68 for every $10,000 invested. As for the portfolio of NIHI, this fund is exposed to around 2,589 stocks, with the top holdings being in companies like ASML, Roche, HSBC, Nestle, Shell, and more, with the sector exposure to financials, industrials, healthcare, and a few others. And if we look at the country breakdown, you have Japan at the top, the UK, France, Switzerland, and more. So this fund is exposed to a wide range of international companies, sectors, and countries. For the income, NIHI has a distribution rate of 13%, and it pays out monthly. Now, the income history is short, since this fund was created in September 2025, but since then, you can see the income does fluctuate a bit, which again is going to be dependent on the underlying asset's volatility. Since it's a brand new fund, the performance history is very short, but it's had total returns of about 9% since it was created a few months ago in September 2025. International stocks did great in 2025 and look to be on pace to keep up that positive momentum. With good earnings growth, the weakening of the dollar, and a variety of other positives are all tailwinds for the international stock market to continue growing. Looking into 2026, international stocks are expected to continue showing growth opportunities due to earnings growth, attractive valuations, policy changes, and if the dollar continues to weaken. At the same time, geopolitical tensions, trade issues, and regional conflicts are something to consider when it comes to uncertainty for international markets. But adding international exposure can be a great way to boost the diversification of your portfolio and reduce your risk from only being invested in the US market. And if you're looking to get the benefits from the growth potential and momentum that has picked up in international stocks, Along with the added exposure and the high monthly income, NIHI could be a nice addition to consider. This next one is quite different from the others, and that's BTCI, the NEOS Bitcoin High Income ETF. This fund is unique since it gives you exposure to Bitcoin through spot Bitcoin exchange traded products, or ETPs. And there's a few important things to consider with BTCI and how it works. First is that it invests in exchange traded spot Bitcoin ETPs. And these are funds that track the price of Bitcoin by directly holding Bitcoin as the underlying asset, so the price of the ETP will move with the price of Bitcoin. Second is that BTCI gets synthetic exposure to Bitcoin through ETFs that invest in Bitcoin future ETFs. And then the third piece, for the income, it uses a call option strategy that's mostly based on selling call options on a Bitcoin futures ETF. For the cost, BTCI has an expense ratio of 0.98%, costing $98 per 10K invested, so it's a tad bit higher than the others. For the holdings, you have a few different things listed. First, you have the ETPs that BTCI invests in, and there's two, which are the Van Eck Fund, HODL, and the iShares Fund, IBIT. Then you have CBTX, which are the synthetic positions with CBOE Bitcoin US ETF index options, and the remaining percentage is in T-bills for collateral and interest. For the dividends, BTCI has a sky-high dividend yield of about 37%, which is pretty crazy. And taking a look at the income over the last 12 months, it fluctuates quite a bit compared to the other funds, which is expected given the high level of volatility that comes with Bitcoin. Which leads me to the performance. Since BTCI was created in October 2024, it's had about 22% total returns, including dividends. And this is after the massive hit that Bitcoin has taken after dropping from its all-time highs of around 126,000 to under 80,000 as of this recording. While Bitcoin's future has always come under question, there could be a lot of possible potential value still on the table when looking over a longer time horizon, given the continued adoption, development, and further regulation of crypto. And you'll definitely have to have the stomach for the volatility, as I'm sure many of you are aware of how volatile Bitcoin can be. And if you're looking for an avenue to get exposure to Bitcoin and the high monthly income that this fund can provide off the back of its volatility and the recent lowered price, this could be a fund to look more into. Moving to the next ETF, we have IWMI, the NEOS Russell 2000 High Income ETF. This fund gives you exposure to the small cap stocks that make up the Russell 2000 index. And like the previous ETFs on the list, it has the same tax benefits of 1256 contracts due to the use of index options. For the fees, IWMI has an expense ratio of 0.68%, costing $68 yearly per 10K invested. Now for the portfolio, IWMI currently holds about 1,974 stocks, with top holdings in Credo Technology, Bloom Energy, IonQ, Kratos Defense, and more, with exposure to sectors like healthcare, industrials, financials, technology, and a few others, giving you exposure to a wide range of different types of small cap companies over a nice spread of sectors and industries. For the dividends, IWMI has a dividend yield of 13.6%, which is paid every single month. For the last 12 months of income, the distributions are somewhat consistent as there aren't huge fluctuations, which is good to see. And if you're wondering how it can have such a high yield, the Russell Small Cap Index comes with more volatility than the S&P 500, for example, which means higher option premiums. IWMI was created in June 2024, and since then, it's had total returns of just over 28.5%, which is solid. And to give you another perspective of these returns, in the last 12 months, IWMI had returns of 16.2%, which is just over SPY and a little bit short of qqqi. Small cap stocks were in the gutter for some years, but recently they've been starting to make a comeback. Benefiting from rate cuts, improved earnings growth, and cheap valuations, there's a lot of potential opportunity for small caps to grow. And don't forget, small caps have much more growth potential than large caps in general, but that of course comes with more potential volatility and risk. With that being said, IWMI can be a great way to boost diversification by giving exposure to stocks beyond large caps, along with higher growth potential and double-digit yields due to the more volatile nature of small cap stocks. Next up, we have IYRI, the NEOS Real Estate High Income ETF. This fund aims to track the Dow Jones U.S. Real Estate Capped Index, which invests in REITs and companies that invest directly or indirectly in real estate through development, management, or ownership. So this ETF has a combination of traditional REIT dividends and income from option premiums. Moving to the cost, IYRI has an expense ratio of 0.68%, like a handful of the other NEOS funds on the list. And for the portfolio, it contains 67 holdings in total, with top holdings in companies such as Welltower, which is a healthcare-focused REIT, Prologis, which is a top industrial REIT, American Tower, which develops and owns communications infrastructure, and Public Storage, one of the leading self-storage facilities, and more. For dividends, IYRI has a dividend yield of 11.4%, which is paid out monthly. And looking at the past 12 months of income, the payouts, as you can see, have been very consistent and stable, which is a huge plus. So IYRI is another really new fund that was created in January 2025, and since then, it's had total returns, including dividends, of about 10.5%, which is pretty good. And you shouldn't have expectations that it'll provide returns like the funds that are tracking the higher growth indexes. Although we're in a higher interest rate environment for some time, with the rates hopefully continuing to come down in the near future, this is a tailwind for the real estate sector over the long term. But there's still risk to the sector if inflation were to somehow accelerate again, or other economic factors which could cause the fund to underperform. Either way, IYRI is for those investors that are looking to diversify beyond stocks and get exposure to real estate while also receiving high monthly income. Next, I have to talk about this one precious metal fund, and that's iaui, the NEOS Gold High Income ETF. This fund aims to generate high monthly income while also providing exposure to gold ETPs or exchange-traded products. Compared to other funds on this list, this fund operates much more closely to btci. First, it aims to track the price of gold by investing up to 25% of the fund's assets in gold ETPs. And it tracks the price of gold through synthetic exposure, which is through a mix of buying call options and selling put options on gold ETPs with a notional value of up to 75% of the fund's net assets. The fund also provides monthly income from selling call options on gold ETPs, and it also earns income from collateral in the form of U.S. government securities like T-bills, notes, and bonds. As for the cost, IAUI has an expense ratio of 0.78%, costing $78 per $10,000 invested. And for the holdings, it looks very similar to how btci was structured. There is the gold ETF AAAU, which is a little under 25%. You have the calls and puts here, and this is where that synthetic exposure comes into play. And then T-bills is where you have the remaining leftover. Shifting to the income, IAUI has a forward dividend yield of 12.5%, which is paid out monthly. The fund was created in June 2025, but looking at the payout history since then, the income has been in a nice, consistent range. And since gold has been on a rise, the fund has been able to lock in higher option premiums and push out these larger payouts. While IAUI has been around for about 7 months or so, it's had total returns of around 30% thanks to the meteoric rise in gold recently. Gold serves a variety of benefits to investors such as diversification, liquidity, a safe haven asset, and a hedge against inflation or other geopolitical or economic issues. And in 2026, gold has been on a massive run, being fueled by central banks heavily purchasing gold, the US dollar weakening, trade tensions, and geopolitical issues. The strong momentum that gold has carried recently has created some pretty big price swings, which is something to consider. While more volatility increases the income for this fund, you'll still feel any hits from any large price drops. And with the wild price movements of precious metals more recently, it's hard to gauge in the short term what might happen. But if you're an investor that's looking further out into the future, that's looking to diversify your income exposure through a gold ETF that provides some nice monthly income, then IAUI is one to take a deeper look into. And if you want to learn about more monthly dividend ETFs, I talk about 6 ETFs for high monthly income in this video here, or in this video here, 3 income ETFs with solid appreciation that together outperform the stock market. If you enjoyed the video, be sure to hit that like button and subscribe. Keep on investing, and I'll see you on the next one.